Welcome to Turtle Talk. Dive into the fascinating world of timeless trend-following strategies and the pursuit of the elusive outliers made legendary by the turtle traders. Join your hosts, Adam and Rich, alongside our esteemed co-host, Jerry Parker, as we uncover the powerful principles of classic trend following. From counterintuitive practices to the mechanics behind capturing market outliers, each episode offers a masterclass in navigating the financial markets. Expect in-depth discussions, expert insights, and actionable advice to help you master the art and science of diversified, systematic trend following, turtle style. Tune in every month as we explore the dynamic and ever-evolving world of trend following, equipping traders and enthusiasts with the tools to succeed. And now, without further ado, let's hand it over to your hosts, Adam, Rich, and Jerry.
G'day, and welcome to episode 12 of Turtle Talk. I'm Rich, coming to you from sunny Brisbane. And as always, I'm joined by my fantastic co-hosts. So from Scotland Island in Sydney Harbour, Adam Havryliv. Adam, great to have you back, mate. What's news from the south?
Still warm enough to wear a T-shirt, but increasingly I suspect I'm going to have to mix up the wardrobe and ditch the branded shirts.
Mate, you had some pretty tragic weather just recently, didn't you?
Yeah, big storm, really big storm came through. Luckily, the house withheld the storm damage, but yeah, probably a few boats down, as always is the case when the weather rolls through Scotland Island.
All right. And from Tampa, Florida, the one and only Jerry Parker. Jerry, how are you? What's happening in your neck of the woods?
Not a lot. Just nice and warm down here and typical 70, 80 degree weather. Hockey is ending, and we're going to go to the playoffs. So, believe it or not, that's a big deal.
Did you win this year? Did you win with your tips?
No. If you're talking about fantasy hockey, I haven't won hockey. Yes, we're in the middle of the championship. I'm in the championship, and it's not looking good. I need a tremendous comeback, like CTA's had before March. I need one of those big comebacks in 7 days.
How's Mike Melasino going?
He lost, and so he's not in. I'm playing Mike's dad. So it's the two old guys beat up on all the young men this year. So but it's going to be tough.
Oh, well. See how it goes. All right, gents. So we've got a bit of a different episode this week. No guest this month. It's just the three of us, which I actually like because when it's just the turtles in the room, we can allow the conversation to go deep. So here's what we've got in store for today. First up, Adam's going to take us through the Battle of the Trends for February 2026. It was another cracking month for trend followers, and there's plenty to discuss here. Then we'll move into what's moved the needle, looking at some standout charts and live market action from both Jerry and Adam. And after that, we're into Turtle Tidbits, an extended deep dive where Jerry and Adam are bringing topics they want to get into. I'll be facilitating and throwing in my own thoughts along the way. Then Jerry's going to lead us through Mythbusters. We'll be debunking one of the biggest misconceptions in trend following, and then finally we'll wrap up the episode. So, without further ado, Adam, take it away with Battle of the Trends.
Okay, Battle of the Trends. So you get that on the AussieTurtles.com website and browse to the ClassicTrendIndex.com page. And we have the February report, which I feel is a little bit dated in the sense that March has just been such a huge month. But in terms of the numbers that flopped in February, great month for Classic Trend. And yes, all of the trend followers did well in February, so that's fantastic to see everybody doing well. Our index up 5.3% for the month in February, which was delivering a whopping 14.6% over the last quarter and 10.5% year to date. So they are absolutely flying results. And I'm looking here at the chart, which has the relative performance of the various indices. And I don't know, I guess you'd call that a hockey stick. We've bottomed out there in, I guess, what was that, March, April, May of May, and then it's been straight up for trend following generally, but, especially the classic trend index. And you can really see us diverging from that pack. But I think, Rich, we were talking potentially about rescaling this, putting it onto a log scale, to make it a little bit fairer for those other guys.
Yeah, you always get the people whinging saying, "Oh, it's not log scale." So I might do that. I might actually include a log chart below this chart in our next monthly report.
Yeah, so I don't know how much difference that's actually going to make, given that it's only a couple of years. But
we're not going to see much difference on the log scale over 5 years. But as it slowly builds over time, we might start seeing the divergence a bit more clearly.
Yeah, and then so in terms of reading that table, we've got a whole lot of yellow highlights, and so some of the cells there are highlighted in yellow. And the legend, it makes it really simple. I guess it's a gold highlight. It says gold highlight equals best result. So you can very simply look for the gold highlights and work out which particular index or metric is performing best. What is the best value for each of those metrics? And proud to say that Classic Trend Index is delivering on almost all of them, really. Total returns obviously leading the pack there, but then even when it comes to the volatility or risk-adjusted measures, the performance is absolutely fantastic. I'm not sure how important winning months is necessarily, whether it's 60% or 63%. I don't really know if that makes any difference to people, but. And then interestingly here, I was noticing that the correlation to the S&P 500 index, we're the only index out of the, 6 or 7 that we have here that has a marginally positive correlation with the S&P 500. I mean, at 0.07, that's, it's not statistically significantly different from zero, but it's funny that the rest have a small negatives and we're the only one that has a positive. But I actually think that's probably because over the period of analysis, the equity markets have basically been going up. So I wouldn't be surprised to see that correlation actually go negative. If we went into a prolonged downtrend in stocks, the S&P 500 in particular, I wouldn't be surprised to see that that flip to a negative. But yeah, that's about it from me. What are your thoughts?
So, look, definitely we had a cracking start to the year. All the trend following indexes had a really good start to the year, both January and February. That really accelerated us into 2026, which is great. Let's hope it continues. But from where we're standing today in March to where we were standing in February with these results is a completely different story. But what I want to say is this. So the position we got to in February was not signaling that the future necessarily would be good. What it was signaling was that our positioning, our extended long-term positioning up until that point of February was appropriate, and we got the reward in February. So this is where we can't afford to use this as a basis to look ahead. We don't know what's going to happen ahead of us in the future. But our positioning in February was basically the reward for the discipline and the positioning that we had for many, many months before that time arose. So it was the dominant sort of metals which gave us that significant result in February. But as we sit here in March, we now see that metals have come off substantially. Equities are starting to come off substantially. Energies are going like the clappers with high volatility. It's a completely different regime to where we ended in February. And these things sort of change overnight, but it inevitably does take a while for our ships to turn round. So I suspect that some of the more classic type of trend following might be finding it a fairly difficult month this month because of the fact that it takes time for loose pants to be unwound and for the new directions to take place. But it's been a great start to the year, but I think March is probably going to throw a few spanners in the works. Jerry, your thoughts?
Well, I think 1 month doesn't mean too much. And I don't think until we get out of these trades, our systems are going to still maintain a position that we should be in the trends, and the trends haven't reversed. So even if your system has you still long gold, and it's because historically when you did the back test, it was better to be long gold in situations like this than to be out. So I frequently hear on all kinds of podcasts that the CTAs, the larger CTAs, are trading systems with lookbacks of 9 to 12 months. So I don't think very many of these trends have been reversed from the systems point of view. And April could be one of the greatest months of all time, or, who knows? But basically, when you look at 40, 50 years worth of data to build your systems, it doesn't really help in the long run to take too much away from 1 month.
Yeah, 1 month is a slender statistic at best.
Another thing you mentioned earlier was 63% of the days or months were positive. I like those. I like stats like that. What I really like looking at from a classic trend point of view is my win percentage over the last 12 months. I want to be very consistent. For classic trend, if you're going to have lots of volatility and lots of give backs, I think I like to be able to offer clients systems that are winning, have a positive return in the 80 to 90% range over the past 12 months. I think we can get away with a lot of volatility and drawdown if we're more consistently profitable. We can sort of point to that as one thing that these systems can deliver sometimes.
Is that at the trade? That's at the trade level, not at the unit price or ETF performance level. Is that what you're referring to in terms of that 80%?
Oh, I don't know what the first one means, but it's definitely just the value of the fund, the rate of return over the past 12 months. If you can kind of get it up there with the long-term systems in the 80% range. So 80% of the trailing 12-month periods, you can be positive. It could be 0.5% positive.
I think I understand. Yeah. So it's basically like winning months, but not for the last 5 or 6 years. It's winning months for the last 12 months.
It's the last 12 months. It's the trailing 1 year return. So it has nothing to do with the percentage of the past 12 months that are positive. But are you simply, instead of just saying December 31st, or have you made money? You're looking at every month, looking a year back from every month. Like, how did we do since last February or last March?
Got you. Okay. So on that report, we're up 15.7% for the rolling last 12 months, and even with the drawdown or reversal in the market in March, that would still be a positive number. I'm expecting that we will still be well in the black on a rolling 12-month basis. But that's an excellent way to look at it. Rolling 12-month returns being positive, because that's sort of, I guess, reflects part of the pain, or the pain to gain ratio of having an investment in something like this. We'll probably get to it later in the podcast, but I mean, if you did that with the S&P 500 and you go into a 3-year drawdown or whatever it could potentially be, that's a hell of a lot of pain for not so much gain. But we can talk about that later, I guess.
All right, gents. So let's move on now to what's moved the needle. This is where we look at the live market action and the charts that have been catching our attention for this month. So, Jerry, first to your charts. Can you talk us through what you've brought along?
I've got 2 charts. The first one we can talk about is aluminum. And it's just an example that we are seeing some other
aluminium, Jerry, or aluminum?
Yes, aluminium. I was gonna put that name to charts that, but I didn't know how to spell it. So so it's in a pretty nice trend, and it's just an example that there are a handful of markets out there, and especially in the commodities, that are trending higher. Not just the precious metals, and palladium, but some of the zinc is doing pretty well, and tin. I think I had the tin chart up the last time we got together, or the time before that, but it's just not. It's just not the precious metals, but also aluminum. That seemed. I'm not sure. I think I read something about the fundamentals. Maybe it has something to do with what's going on in the Middle East or something. But it's another great market too that so few investors have access to, unless they're invested with CTAs. The second chart is bean oil, and I think maybe you can trade soybeans and corn and wheat. But of course, all of us, we like to throw in as many of these alternative markets or, smaller markets as possible. And the chart also shows the move around, I think, 20 and 21, and bean oil had a big move then as well. And it's outperforming soybeans and almost everything else in the grain complex. So once again, showing the value of trading as many of these markets as possible. And even though soybeans look pretty strong and the wheat has been breaking out as well, there is a big leader, and it is the oil. So I'm a big, I think bean meal is kind of a short trade. So once again, you can get even markets that sound similar or can be correlated. You can have different positions on.
Yeah, remember Bruno. I think Bruno was the wise one who gave us the rationale for why we should be trading both the oil, the meal, and the soybean direct. They do definitely have different characters. So, on to you, Adam. Your charts. What do you want to go through?
Okay, so sort of on a similar vein to that, you've got gas. You'd think gas is the same thing all around the world. I'm talking natural gas here. So I've got a chart, the 1 year chart for European gas, priced in euros. That's had a huge move up this month, and you can see there. I mean, at one point it was up 100%. For the month, a lot of that, in just a couple of days. Now, obviously, that's getting these trend-following models interested in this trend. And so the 1 year chart there, explosive on European gas. They've got some localized supply concerns, as it relates to Russia and the Middle East for their gas. And then compare and contrast that with US natural gas, which, yes, it had a bump up, something like $3 to almost $5, but that's given up all of that gain, and then we're back here. Looks like the front month is back under $3, and that trend is not, continuing. But interestingly here, I thought, let's get some perspective on, our market's already up 60, 70, 80% in 1 month. Maybe that's it. And there's not much room here for this trend to play out. So then you zoom out to the 5 year chart on natural gas, and you look back at what happened in 2022 when Russia invaded Ukraine, and it was an absolutely massive trade for trend followers, and anyone who was in those contracts would have done really, really well. So, I think watch this space. We're only 1 month into this, Middle Eastern conflict, and this could get a lot more wild, especially in the energy complex. And, bringing it back to, the big benchmark, we've got, Brent crude, the international benchmark for oil, a super big breakout here from the, let's call it the 75 level. We've moved above the 200-day moving average, and it's just rocketed away, breaking out through those 52-week highs or whatever breakout level you want to use, and we're up here 114. That's in the April month. I think May is slightly lower, but a little bit of volatility here. But I'm assuming most people, your pants are loose enough, you'd still be in these energy trades. So that's what I'm looking at.
Unless you're using dynamic position sizing and reducing your position, as the market continues to rally, you keep selling. So,
dynamic position sizing, yeah, you would have sold out of 80% of it, and you'd have nothing left. And because you'd want to normalize the volatility and have a vol-adjusted, exposure to it. No,
you want to eliminate the outliers. They cause so many problems.
Well, something that we definitely can agree on here is that if you're on a winning trade, just let it ride, I guess.
Yeah, Jerry's dripping with sarcasm today, which is good to see.
Yeah,
they're a good set of charts, guys, and it's that was very interesting about the different forms of gas. Just going to show you again that treat correlation with a fickle hand, because there's significantly different character even in the gases, European versus US. That's quite impressive.
This might be a myth buster, but I get really irritated when I hear about this correlation, because it's like correlation is not a part of a non-normal distribution like it would be in a normal distribution, which when you're dynamic position sizing, you're trying to create more of a normal distribution anyways. But correlation is one thing to be concerned about. I mean, when I put trades on, I hope they're all correlated and they all make a lot of money. But like I was mentioning in the bean oil, it really is irrelevant sometimes, because you can have two markets that are very highly correlated, and one makes 10 times as much money as the other. So really getting bogged down with correlation really cuts your profits short. This is a really good time to look at, a few months ago, 6 months or so, with the first, I guess it was a year ago when we had the tariffs, I finally realized that I should trade both coppers, New York and LME. And then for some reason, I've always traded both crude oils. And now with things happening in nearer Europe than it is the US, there could be different things going on with those two contracts. Even though they're highly correlated, we may get a bigger move in Brent just because it's going to be more impacted by the Middle East. So I remember looking at lists of markets to trade and saying, I'm not going to trade soybeans in China because I already trade soybeans, which is a huge mistake. So now I'm on this hunt for markets that I could currently be trading, but they're located in exchanges somewhere else in the Middle East or Europe. In Asia or Europe, and not to write those markets off, because it could have a whole different profile, a whole different move, even though most of the time it'd be highly correlated. So just a little twist on what we were always talking about. These markets can really have different moves. That's what the outlier hunters are looking for.
Yeah. No, exactly. I think too much focus on correlations. Yeah, it certainly does smooth the equity curve, but that's not what we're after. It actually it gives us a disadvantage when we're outlier hunting, so it just doesn't fit within our vocabulary for our objectives that we're trying to achieve. It might fit into different objectives, but it's certainly not from diversification to catch these anomalies or these massive moves. Correlation, a focus on correlation detracts from that objective.
Yeah, you might also find too, markets might be correlated whilst shipping lanes are open and supply chains are working as expected. But if you have a breakdown in that, So you block some supply chain, or there's a disruption, like a war. The correlations can go out the window, and you can get really unexpected results.
That's what I wanted to say. That was so eloquent. Golly.
Now the important thing is being on the right side of that trade, and that's where the trend follower taking the breakout and not overthinking it. You just go long at that breakout, or you go short at that breakout, and the correlations they'll be what they'll be.
And the more markets you trade, the more irrelevant it is to trade 2 or 3 markets that are highly correlated. With 400 markets in my portfolio, trading Brent and WTI, if for the rest of my life they're 99% correlated and they make the same amount of money on every trade, it didn't really matter too much. So you can get away with potential issues like that. I think in the long run, it's not a potential issue. It's an opportunity to trade both of those markets. But if it isn't, the more markets you actually have in your portfolio, the less concern it is if it doesn't work out the way you want it to. Double trading energy, crude and Brent crude and WTI is irrelevant in a large portfolio.
Yeah, tariffs are a good example of that because US copper and London copper diverged based on a potential tariff impact or pricing in of a tariff, and then when it got unwound. Because the tariff policy was reversed, the impact in the US copper market was a lot bigger than the LME. So you can get really, really strange outcomes in markets that you'd think would be mostly fungible because copper can be shipped and replaced geographically, but tariffs really could put a spanner in the works. So in an environment that we're in now, I think we're probably going to just see more of this. More and more crazy moves in commodities and divergences in relationships that we thought were stable.
Yeah, there's going to be many people rapidly changing their models, I anticipate. All right, gents. Any more to discuss here with the charts, or shall we move on to tidbits?
I think tidbits sounds good to me.
All right, so here we go. Turtle Tidbits. This is where we dive into some topics and ideas that we want to take a deep dive on. So you're up first, Jerry. What have you got for us today?
Well, I sent over this idea that about reading this paper, and it once again is about diversification in markets, and the authors brought up this idea that a more concentrated portfolio with larger markets would have a better performance during a stock sell-off. So the more financials you have, bonds and stocks and maybe currencies and gold and some of the bigger commodity markets, the more that's going to help with crisis alpha. But the more diversification you have in a portfolio, the better the performance is going to be. So I know that Managed Futures raises money with the marketing idea of we're here to help during the stock sell-off, but I see it as kind of a missed opportunity not to choose the better performance option. And people are always complaining about performance. So they're complaining about performance. They're down on CTAs. We're begging them to put us in the portfolio because we'll help when stocks sell off. And then even maybe we're even altering the systems a bit to be shorter term, so I can short the S&P futures quicker to help to really have a great impact on your portfolio of traditional assets, stocks, and bonds. And I just see this as two really different choices. And I'm going to choose, shockingly, more markets, better performance, because one of these days, classic trend is going to have better performance than the stock market itself. I know that's like heresy, but it used to be that way before the 2000s, where we would make more money than stocks and obviously have less volatility. And that we could get back to that, to where the number one choice for a portfolio could be trend following, classic trend, and a broad portfolio, versus now we kind of beg and plead, please invest with us 5% so we can be part of so we can maybe be part of your portfolio and help out when stocks don't do well.
Yeah, that's a really good point. Like, I'm assuming this man's study, I can understand the principle. Yes, if you narrow your universe to those that are counter-cyclical to equities, you can therefore achieve good crisis alpha benefits, but as a result, sacrifice your long-term performance. So this is where I see this trade-off occurring, where I think some CTAs might be lured into the objective of providing crisis alpha protection, but mind you, there are other programs such as long vol programs which probably do it better. So why would you focus your objective on crisis alpha protection at the expense of your long-term performance? This is what I can't understand. I suppose it might be a business decision that they attract more AUM by being part of a traditional portfolio as opposed to a standalone portfolio. But it makes no sense.
Yeah, it's all about AUM. And it's also with the assumption that the underperformance of trend following is going to continue versus equities. And so this is something that, you kind of know you should have. It's different. It is a diversifier that doesn't take money out of the portfolio. It contributes performance to the portfolio. Not enough, not as great as these wonderful equities, but I think that could change. And this would be a shame if trend following performance got a lot better, but we're not positioned with our best systems and our best ideas to take advantage of a new regime change, which is stocks are not always going to outperform. And I feel like has been so much success with creating products that are combinations of long equities and managed futures, that so many different firms are coming out with their own spin on this, where you'll be long S&P or long stock indexes all the time, never getting out, and then combine that with your managed futures trend following. That I think this has become such a popular thing that this could be the turning point where trend following alone, trend following plus nothing could have a really good period. That's what I would expect. And I don't really understand how you could come up with a different conclusion if you've seen the back test and you understand the back test, which all of these people and all of these companies have in fact done the back test and seen the numbers. But once again, it is about raising assets. I'm jealous I don't have my own fund like that. I wish I would have. I should have done it 10 years ago, but now
sold to the devil, Jerry.
No devil.
Adam, thoughts on Jerry's idea?
No, I love it, and linking this into current markets, they are expensive. Equity markets are objectively expensive. You can use the Buffett indicator. You can use the price earnings model. You could use the Shiller-Cape PE. You could use a price to sales. You could use a yield curve model. All of these things are flashing red on valuations, and the certainty that stocks are going to deliver. Look, they might deliver over a 10, 20, 30 year horizon, but if you're looking at the next 5 or 10 years, in my humble opinion, not financial advice, stocks look a little wobbly. Indices look a little wobbly. I'm not getting into individual securities here, just indices. And so trend following has a real role to play in protecting and just making a portfolio more robust.
did any of you guys come across that article by Harry Krishnan and I think it was Professor Green about the rise of passive investment and the potential impacts of a market crisis with this dominance of passive flows? They were stating some very large potential statistics there that make you sort of stop and pause for a while just to consider what would happen in a scenario where there was a protracted bear crisis.
I did see that.
In that level, yeah. And what did you think, Jerry? You agree with it?
And I don't know. I mean, I can't say that I agree or disagree. I just thought the numbers were eye-popping. At one point, they say 90% drawdown or 100% drawdown was possible.
Yeah.
Yeah, so it's kind of crazy. But, I mean, I think to some degree, we are guilty of doing the same thing that passive does, which is don't pay attention to the fundamentals, freeload. There are smart people out there trying to value companies, and we're buying the breakouts, and they're just investing in passive. And so I'm not really sure. I do think that the whole mystery that there was going to be 7 stocks and they were going to carry the index and they were destined to keep going up, that has kind of faded because I don't think those 7 stocks have done very well recently. So that's good to see that things can change like that.
I think that gives a good segue into Adam's topic. So, Adam, what's the topic you've brought along today?
So I want to talk about trend following versus passive long equity index investing. And I want to really talk about the difference between the two and why I would advocate trend following instead of passive. So, we've talked a little bit about, let's say, current market valuations. And personally, I think they're extreme. And, if you look at the Z score on some of those indicators that I just mentioned, two standard deviations above the mean for those valuation tools, that's sort of giving me the basis for where I start with passive. And so let's just ignore that for a moment and then think about what we're watching on the TV screens and what's unfolding in the Middle East. We've got energy prices exploding. We've got inflation pressure. We've got potential central bank tightening, depending on how the economy responds to this energy shock. And what is passive long index investing? It's basically a bet on economic growth into the future. But this sort of regime that we're potentially entering could be quite negative for equity index investing. And if you look back to, I guess in recent history, we'd be looking at the 22-23 period, which I think is on a smaller scale of what we're experiencing potentially today. We had energy prices go up, we had food prices go up, a real disruption to the global economy, from things like fertilizer and grain prices. And we did have a big hit to stocks and bonds, and trend following did absolutely fantastic. But if you go back to, I think, the 73-74 oil crisis, which I think is probably more comparable if this goes on for much longer, the S&P 500 fell 48%, and then, presumably took quite some time to recover. Now, in our modeling and in Jerry's historical experiences, these types of drawdowns in trend following are very, 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 very rare and unlikely to occur on the same scale as what appears to be a regular occurrence in equity indices. 2008, 2022, and then those prior crises. So what I like about trend following is that it effectively can profit from the drivers of the crisis. So this month in trend following, what did we do? We bought energy across the energy complex, whether it's gas or oil or the derivatives of oil. We've looked at buying or we bought some grain products, effectively systematically going long markets that are trending up, but are the result of the unfolding crisis, right? So actually, an energy shock can be a profit driver for a trend following system, unlike a passive equity index investment that effectively is getting hit, margins, interest rate, and economic growth. Secondly, we're not yet there, but our models have been selling equity indices, but also have the potential to go short if the correct conditions unfold, right? So not only can we go long of the assets that are appreciating during a crisis, but trend following models can just as easily go short as they do go long, and that means short positions in bond markets and equity indices, and then even potentially individual stocks, depending on how the models are configured. So, the dot-com crash of 2000, the global financial crisis of 2008, short positions are a huge contributor to classic trend following returns. So, I've talked about energy, I've talked about equities. These crises produce cross-asset trends. So that's going to get the bond market involved, the stock market, commodities, and foreign exchange. And when you've got trends firing on all four cylinders, that's when you get, the big yearly, monthly returns in trend following that could potentially unfold this year. And then finally, if I was just bringing this, all to a conclusion, is that none of this relies on a forecast, right? So I can have my personal opinion on what is unfolding in the Middle East. I could have an objective opinion of valuations, but then I could have some subjective views on what I think the stock market's going to do. But none of that's going to make a difference to how a trend follower behaves, because basically we're going to look for evidence in the breakout before we take a trade. We're not going to make a bet on a mean reversion in a valuation metric. We're going to look for confirmation through the form of a sell signal on a price, and that's going to lead us to that position. Effectively, we're going to let the market do the talking and keep our opinions to ourselves as it relates, to the trading. So in closing, I think it's going to be potentially quite a difficult time for passive long-only equity. I know I would rather be in trend following, whether it's 100% like Jerry would advocate. I mean, obviously we're 100% trend following here at East Coast Capital Management, but even just a partial allocation, a material one that is going to make a difference and buffet any falls in stock markets should these unfortunate events continue.
Great points, Adam. Jerry, your thoughts?
Well, we've seen some really successful CTAs have some large drawdowns, but what they don't average is 10% return. I think it's almost impossible for a decent trend follower to have a return drawdown as poor as the S&P, 10%, 50, 60% drawdown. But here in the U.S., it's just no one can lose faith in the stock market. They just all have this amazing faith and belief that capitalism and business is going to continue. And this is the lesson that they want to take away. But I think that there is one thing that could possibly stand in the way of the sort of growth and expanding economies and increased standard of livings that are going to drive stock market returns. And that is these governments. They can't be trusted with the way they handle the money and the inflation and the taxes. We have all kinds of bad European-like ideas coming to the United States with wealth taxes and higher marginal rates that could doom our economy and all the growth we have. So I'm with you guys. I don't. It's never a given, just because it's gone on for a long period of time, that what is working now is going to keep working in the future.
Yeah, I love our strategy because it's adaptive. Short, long, massive diversification, waiting for these material moves, responsive strategy. Unlike, say, passive, which is really just a concentrated bet on a single premise, economic growth, which, I think is a massive risk proposition from at least the way I see these markets work. But no, they are great topics, guys. So I think that's a wrap on the turtle tidbits for this episode. So let's move now on to Mythbusters. And Jerry, do you have a Mythbuster to share with us today?
I didn't bring a good Mythbuster. I forgot about it, honestly, but like I did mention something about diversification being kind of a myth. The way that we sort of look at diversification, which is one of the definitions on another paper I read, was that diversification is all about lowering volatility of the returns. And it's just something that trend followers, classic trend followers, don't really care about. You don't need to trade all these markets because they're sort of correlated. 40, 50 markets is enough, or 21 markets is enough. And so I think this could be true in some traditional portfolio building methods of long equities, long bonds, long some gold and Bitcoin. But for us, it's not true that this is the benefit we get from diversification is lower volatility. We get these outlier trades. And the shame of it all is that if you wanted to get into a big argument about this, you're probably going to be arguing with another trend following CTA.
Yeah. Yeah, we're our worst enemies. That's right.
Well, not the three of us, but
yeah.
It's just, I don't think there's anything more important as it relates to, to trading and the way that in trend following are these type of issues with dynamic position sizing, which leads to this idea of Sharp, which leads to this idea of you don't need to trade lots of markets, which you don't need to make outlier hunting your primary goal. These topics which we continue to discuss and people joke around and laugh. Why are we talking about this again and again? It's because it's so important. Yeah. It's the heart of what we do.
Yeah.
Yeah, but to be fair, right? I think personally,
I'm not interested in being fair. No, sorry.
I would rather be in a DPS trend following fund than passive long equities, right? Now, obviously, classic trend is the best, right? The way we do it is the best because we're going for those outliers and we're not reducing risk when it's paying us. But I would still rather be in a DPS trend following fund than long the S&P 500 or the ASX 200.
Well, that's interesting that you say that. I'm not going to agree necessarily. I have to think about that. But I'm not sure that Rich would agree either. And I think Rich has thought about this for a long time, more than I have. And my guess is he doesn't agree with that.
Yeah, my guess is it comes in line with this 100% trend TFPN concept of Jerry's. There is only one way to trend follow. This is the way we're doing it. To be DPS is to accept mean reversion into your strategy. And I am totally against the concept of mean reversion as a way to maximize returns over the long term.
Right. And I think here's one of the problems with your argument too. And that is, if mean reversion, non-classic trend following, if it doesn't work, it's leveraged. And if you put your money in the S&P, it's not leveraged. Losing all of your money in the S&P is probably impossible. As short of the world still going on and still existing, losing your money in a bad systematic approach, not impossible.
Who is the most DPS-y index out of the indices on the...
B top 50 would be the most DPS because they're sort of not just trend. They've got mean reversion, pattern recognition, all of those sort of things incorporated into them. They're less trend specific than say SG trend. So B top 50 would probably.
But are you saying you'd rather be in the S&P 500 than the B top 50?
No. Bottom line,
but I want to let me just 5
of us classic trend followers or nothing.
Yeah, all 5 of us. but I think I don't. Yeah, I have to. You're missing something there, and that is that the most widely quoted managed futures index is not the SocGen trend; it's the SocGen CTA.
Yeah.
That has all those same characteristics.
So that's more DPS-y than the trend index.
That's more DPS-y than
SGCTA is more DPS than SG trend.
That's one Andrew Beer
exactly.
SGCTA.
But and every managed futures manager in that index has a lot of those non-trend aspects to their system. Not just maybe there's some in all of these indexes, some CTAs who don't have any trend. Okay, I don't know who they are, but it's definitely possible. But then all of the CTAs in the index have a lot of non-trend. So you can't get away from DPS. I mean, it's 95 versus 94%. Yeah, okay. One of them has more than the other, but it's a trivial amount more.
So I can see the marketing appeal. Oh, DPS, we let go of some silver at $120, or we let go of some gold at, I don't know. I'll pick the high here. We let go of some gold at 5,500. But the numbers just don't reflect that that's a better strategy. I get the marketing spin, but the numbers aren't there.
Yeah, here's another, and the future numbers are not going to be there. The future risk is underestimated. And here's another myth. Richard Dennis and the Turtles used the ATR to size positions. And so we're just carrying that logic one step further, that we're going to resize the positions every day with profits as well, based upon this ATR. The myth is that's a myth. Richard Dennis said use the ATR to size your positions and normalize the losses. You give each trade 2 ATRs before you exit with a 2 ATR loss. You lose 1% of your equity, and all the losses look the same, regardless of which market you're trading. There was never any idea that you're supposed to treat the profits much different. You let them run. If the ATR doubles, triples, quadruples, that's wonderful. And the new method from the Europeans was, no, we need to get rid of these outliers. We need to smooth things out. We're all solving for Sharpe. So Sharpe is a big evil.
So
for proper trend following.
If I look at my trade statistics and I look at the most profitable trades, right? So the ones that had the biggest P&L and made the biggest contribution to performance, the biggest predictor or correlate to that performance is the time in the trade. So actually, you want to give yourself the loosest pants and have the widest stops that you can handle through smaller position sizing, that allows the trend time to develop and become a meaningful contributor to P&L. So a trade that goes in the money and is doing really, really well, in my mind, is just the trade to keep on. I see no statistical reason to reduce the exposure to it.
Yeah. But sometimes when we say, we'll say on podcasts, Rich and I will say, you're cutting your winners short and you're getting rid of outliers too quickly. They'll say, no, I still have it. I still have my 9.5% of gold left. I'm still in the outlier. Yeah. What do you say? What can you say?
Just doesn't make sense to me, Jerry. And
shake your head. Yeah.
Just shake the head. Well, the good thing about this segment, Jerry, is you've brought 2 Mythbusters into this segment and without having any to start with. So that was a good effort.
Yes. Oh, thanks. Exactly.
All right, gents. Well, I think it's time to move up to wrap up the episode. It's been a great show, just the 3 of us today. We've covered some good, serious ground. Jerry, any closing thoughts before we sign off?
My closing thought is do the trades and follow the system. And recent performance doesn't mean anything. It could get much better or it could get much worse, but you should have rules that can take care of all of these situations. So we need to be as optimistic now as we were at the end of February.
Yeah.
Yeah, and optimism means I love my system and I'm going to keep doing it. And I have all my faith in its performance.
Isn't it great? Of all the years we've known each other all, we're as happy as a pig in mud with our system. I think that's pretty impressive. At all times during this time I've known you two, at least, I've never been happier. So it's a great system we've got.
Yes, great system.
Adam, pearls of wisdom to end off the episode.
So my closing thought is that I sleep better at night trend following than I would if I was passive long equity index.
Yeah.
So up and down, month to month, quarter to quarter. But yeah, trailing 12-month returns, I mean, they're almost always positive for trend following systems. And you just can't say that about the stock market. So we could easily go into a 3-year bear market based on prior history. And so what's that going to do to your retirement? What's that going to do to your plans? Are you going to be cutting back on travel? I'm not, because I'm long trend following. And what that means is the crisis actually becomes the opportunity. So I sleep well at night knowing my money's safe, but then I actually know that potentially this is going to accelerate my wealth creation.
Yeah.
Because the trends that come over the next 6 to 12 months could be explosive. And if not, guess what? We'll sell those trades and we'll just get back into the long equity market, and we'll join the herd if it all if it all just resolves itself.
Yeah,
exactly.
The S&P, I think it's down to 6351 or somewhere like that right at this point in time now. And if I was in passives now, I'd be thinking to myself, oh my goodness me.
Well, you'd be worried, wouldn't you? Like, what do I do? Do I sell? Do I hedge? Like, or should I have sold at the top? I mean, the beauty of the trend following is it's all programmatic.
Yeah.
Like, we know exactly what we're going to do when we start the day or the month.
Yeah.
Well, they have some cult members that feel the exact opposite, and that is they would be buying more. The more it goes down, the more they're buying. But I tell you right now, I think that these people who invest like that, they deserve all the money that they get. They're taking way more risks than I am. They deserve these outsized profits. I hope it continues. I hope it's not going to be something they regret. And I'm willing to make a little bit less by using stop losses and trailing stops and massive diversification in shorts and everything that we do. So good luck to someone who buys and buys more when it goes down. They need it. They need good luck.
All right, gents. Well, before we sign off, a quick reminder about my book, The Fractals of Finance, which many of you will have heard us discuss in episode 11. So it's available on Amazon in Kindle, paperback and hardcover, and just search Fractals of Finance or my name and you'll find it. If you haven't picked up a copy yet, I'd love for you to check it out. And if you have read it, perhaps a short review on Amazon goes a long way in helping more traders discover it. So, Jerry, as always, thanks for writing the foreword, and it means a great deal to me. So thank you for that.
You're welcome.
So one quick note before we go. There will be no episode at the end of April. Adam and I will both be away in the fabled Spice Islands of the Malay Archipelago doing some turtle exploration. So, but we will be back at the end of May, refreshed, slightly sunburned, and ready to bring you all the latest from the market. So stay tuned. And in the meantime, don't forget to send us your questions for our shell mail segment via the Aussie Turtles website. So that's a wrap for episode 12 of Turtle Talk. If you enjoyed today's show, please leave a review, share it with a friend, and don't forget to subscribe so you never miss an episode. So, as always, stay systematic, stay patient, and may the trend be with you. See you in May.
Thanks for tuning into Turtle Talk. If you enjoyed the episode, don't forget to rate and review the podcast. It really helps us reach more listeners. Share it with your friends and invite them to join the conversation. Got a question for us? Send it to info@aussieturtles.com, and we'll do our best to feature it on a future episode. Please note, Turtle Talk is for informational and educational purposes only. The views expressed by the hosts and guests are their own, and do not necessarily reflect the opinions of the podcast producers or affiliates. This podcast does not provide financial, investment, or professional advice. Always consult with a qualified professional before making investment decisions. That's it for today, folks. See you next time, and as always, may the trend be with you.